traders are looking at it going, look how tight the market is. I am not going to be short here. I can't possibly think of being short flat price. They're just being stubborn against the backdrop of all the things that drive markets these days in the outright price. And so it could just be a repeat. The stubborn people tend to be the ones that hold on the most and then have the most aggressive stop outs. Hello and welcome to another episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, and today I'm joined in person with Martha, James and Vincent. So this week is International Energy Week, formerly known as International Petroleum Week or IP Week, where oil market participants across the globe come and meet. Nothing too crazy has been announced, but this is the time where we usually expect something funky to happen in markets in these times, believe it or not. So we are still on the lookout for unexpected volatility. As for the market state, we just can't shunt out of this range once again in Brent futures, yet the underlying markets and niche futures are putting on quite a show. For the outright price, it has been a quarter of diametrically opposed forces cancelling each other out so far, with crude markets continuing to strengthen, product differentials reaching peak volatility, whilst macro market sentiment is skeptical at best. We are in a bullish market regime for oil, there can be no doubt, but as is the case with modern markets, where and how you reflect this trade is the challenge. So Vincent, can you start us off?
Of course, so it's been another range-bound, albeit less bullish, slightly bearish week in Brent futures. So crude prices had come off from around $84 down to the low 80s, where it found some support on Monday. Initially, it was off the back of weakening demand sentiment, some profit-taking flows on the CFTC data in the most recent week. It was seen that actually there was some addition of shorts in Brent crude futures. That was the highest addition over the last 4 weeks. So there's a bit more opportunistic short sellers wanting to enter at the top, but as Brent comes off to the 80s, there's still some level of support, and that actually had fed into more of the niche futures markets, the dated physical market actually. So the DFLs, the dated Brent versus forward Brent, had been coming off substantially since last Thursday, but actually found better support on Monday. So if you look at it in isolation, it has been on a very bearish trend, but if you look at it within the range of the whole month, it had been tremendously bullish, and only recently it's been just a bit less bullish. So we definitely are still in a bullish regime, but it seems like the market is looking for more nowders to push this up, especially with the macro sentiment seen as of interest rate cuts will be delayed. So it's a confluence of both bullish factors. You have the geopolitical side versus the bearish macro.
Yeah, one thing that's interesting for me, like really interesting, is all that you're saying on the Brent futures is one thing in terms of the outright price, but seeing the way the market's reacting on Brent spreads, which is having a knock-on effect to the rest of the market. If you really have been watching it very closely, we have gotten to very high physical differentials in the North Sea market. So we were printing roughly around $2.25 per barrel on the physical differential, which means that's the premium on top of the spot market benchmark. So that's very, very strong. But people are unsure whether that's going to follow through into the time spreads into expiry. It gets all very technical and complicated, but ultimately it was so interesting to see the market kind of short covering rally, then gets long, then a very strong performance in time spreads in benchmark differentials, and a bit of the case in Brent futures. Yet in the last week, as you say, it's been a bit less bullish because cargoes started to come in on the offer side in these like tender windows that are used to set the price. We had March delivered cargoes, the end of March delivered cargoes coming in from the US and some local grades, and it weakened that differential. But then once they got bought, everything rallied back up again. So the volatility is being like made by one or two or maybe three cargoes, and that's affecting the entire world's oil price. So it's just yet another reminder that this marginal barrel in this relatively small location is incredibly important for the world's pricing of oil. So the Brent expiry is, I want to say Wednesday or Thursday. Thursday, and this is when we start to see for April loading cargoes. What is the appetite to have them, given that they're still a month and a bit away before they load? It's a really, really important time, and I'm just positive that the market's all watching that intently, because I think a lot of people are now long the time spreads across markets. They're long in general in oil markets. So if there's going to be a surprise, it could be that, the North Sea market gives up, and with maintenance around the corner, that was a big reason for being bearish, before the last rally of the last few weeks. Could that now have been something too early? And actually, that's when the market starts to price it in. Sorry, now is when the market starts to price it in, as in April loading barrels refineries don't want, because they're undergoing maintenance and March cargoes, and suddenly we get a big collapse when the whole market's long, and that will definitely feed its way through into Brent futures. So that's the type of volatility we're keeping a really, really keen eye on. Just to finish that off, if you look at all the product crack markets, product differentials, propane markets, NGLs, petchems, yes, they have their own dynamics, but undeniably, this rally in the last few weeks has been very correlated across all markets. So a retracement of that move will, by definition, should have a big impact on the rest of the products as well. So it's a really important time. But in terms of statistics, Martha, could you give us a bit of a summary, key ones?
Yeah, of course. So just crude-wise, the EIA stats released last week, we saw a crude build in the States of 3.5 million barrels compared to the 3.75 million barrel predicted. The Cushing crude's up 741,000 barrels. Refinery utilization is still lagging the expected rate. It's at flat it's at 0% increase compared to last week, estimated 0.5% increase, so we're not seeing that pick up, although the inputs have increased a little bit, 32,000 barrels a day.
Okay, moving on to refinery margins then, what's been the talk there?
So week on week in Europe, we saw an improvement of $1.25. This is stemmed mostly down due to the weakness in the data structure, as you guys have mentioned, but also we've seen pretty interesting moves in gasoline and gas oil, so light and heavy. Starting with the heavy in gas oil, we've seen real weakness in prices. Poor European demand. Technically, the prices are heading lower and lower. They're seeing lower highs and they're trending down. The Cape of Good Hope ships, the ships diversed around the Cape of Good Hope are finally arriving in Europe, and so there's more supply. And then in the more physical, the barges premiums are down, and we've seen a little bit of Belgian wholesalers selling, which the wholesaler movements are quite indicative of general appetite. So that's not great. Interestingly, I looked a bit at the American refinery margin this week, because basically across the whole distillate complex, across the whole gas oil complex, it's been really, really weak across all regions, but heating oil especially has been really, really bearish. So in terms of stocks that we were just saying, even with distillate seeing a 4 million barrel drop in stocks, was about double the expectations. There was essentially no support given to heating oil from this. Even with refineries and turnaround, it's not seeing any support. So it's just a really bearish feeling across the distillate complex, across all of the regions.
Yeah, that's actually very interesting to hear. And I guess another indication that we know the market got very long product differentials in general. We talked about it last week. And that kind of reaction to these things, with refinery outages, to still not move upwards is pretty bearish thing, and shows you it's very oversaturated. So kind of another point to add on what I was saying before, which is if there's going to be volatility, it could be a bit of a retracement. And I think when you talk to the traders, a lot of the way the refinery margin or refinery product markets are trading right now is as if there's going to be huge refinery outages. And on the one hand, that's clearly viable, because there's been the Whiting, there's been one recently, Grangemouth, other European refiners, and we're only going to get hotter this year, and that's where you get refinery fires. So it's not ridiculous to price these things in, but if they don't happen, you've got a very heavily weighted long market that will be under serious pressure, basically. Okay. What about the macro markets, James? What have we got to watch? What's been going on?
Well, in the last week, really, the big news was the Nvidia earnings came out and massively beat the market. Equities, so the Nasdaq, the S&P jumped again to new all-time highs. On the back of that, we finally saw the Nikkei making an all-time high back after 34 years after its previous peak in 1989. Without a doubt, though, these stocks in the US, the tech stocks, AI stocks, are getting pretty expensive. Forward PEs for the top 10 tech stocks are now at 40 times earnings, compared to just 26 times in 2000. Another piece of data, important data, actually came out overnight. Japan's CPI was expected to continue falling. It peaked just over 4%. It's expected to come in overnight 1.9% year on year, but actually surprised to the upside at 2.2%. So what we've seen now is the OIS market is now expecting the Bank of Japan to raise rates either March or April.
And this is a scenario where this is kind of bullish, raising rates in China, whereas everywhere else it's kind of, well, it depends, but because it's a bit more of a return to normality with the rates that have been negative for so long, it's actually been seen as quite bullish to equity markets, isn't it?
Absolutely, yes. Yeah. In Japan, bullish for equity markets. Nikkei, it's been pushing higher, and the Nvidia earnings help push it to all-time highs.
And what does that do for the wider Asia region, which just needs all the support it can get right now, it seems?
The problem is outside that, we're still seeing weakness in China.
Okay.
House prices came out lower again last week, and also the 30-year bond reached all-time highs, the bond price, which is showing there's no confidence in a sign of strength in the Chinese economy.
But again, we've talked about this getting to the stage where it's got to be priced in at some point. Is there just still no real evidence of less bearish things, at least? Or
absolutely, it seems like the markets are in limbo. We're seeing the same in the US. Employment's strong. We're not seeing any deterioration there. Manufacturing's in slight contraction, but again, no deterioration, but again, no bounce. So it seems like we've been in this situation for 2 or 3 months. The market's waiting to see either bounce or contraction. The cuts that were being aggressively priced into the US have been unwound, and the central bankers continue saying we're going to stay with rates higher for longer.
What do you think? Kind of is a little bit of a tangent, but when you talk about Nvidia, people talking about the comparison with tech stocks and this tech bubble. And I actually read a few things when you put this out there. At the end of last year, there was a lot of talk about this, comparing the two. To me, the whole point of a bubble is you kind of don't know it's there. So when people are talking about it, and in 2023 we were promised a recession from a lot of different, billionaires, investors, and politicians, everyone was predicting it. It didn't happen. It just seems more and more like the democratization of information and understanding of equity markets and macro markets and moving money around. Because people are so worried about there being a bubble, it's been very, very much talked widespread. And the latest one again is that we could be in another bubble. They're comparing the recent events and recent bubbles and then comparing where we are now and say, how can you not think we're a bubble? And there's all this kind of attitude to understanding where we are, where the whole point is bubbles before people didn't know. So in a way you can prepare for these things, and the fact that everyone is so prepared and in wait and see mode, doesn't that kind of tell you that it's unlikely to be a recession because people are pricing it in, or people are at least not exacerbating bubbles? Do you see what I mean?
I do. I think with the equity markets, for instance, I think a big difference here is now, as you said, everyone has access to the information, but now retail traders have access to the information in real time. And retail traders behave differently in the fact they don't want to miss out, instant gratification, and they want to chase these price moves.
But it can work the other way. They can get very spooked. And I think this kind of, flood away from, risky assets, we do see it. It does. There are quite a few risk-off moves these days that don't follow through into like bursting bubble type moves. I mean, that's a very superficial observation. I'm not trying to put you on the spot, but it's just something I feel like we're starting to notice, and it's a good thing. I think everyone's at least talking about it, should at least be aware. There's not something out of the blue. In past we've had a lot of people saying, "No, you told me this was going to be a safe investment. You told me this was all going to be okay, and I've lost my pension." Feels like less of that now. People have more ownership. People can at least aware of what's going on. Anyway, that's a superficial observation. I hope I'm right, because you don't want people unaware, and that's kind of a recent phenomenon. Power to the people. Okay, so Googling oil, Vincent, what's been going on?
Yeah, so recently is took more standard headlines, but a bit more interest as people aware that this is in the context of IP Week. Have a recent one from Bloomberg: oil rises on US physical market strength, China demand hopes. So it's about the bullish narrative going into Monday, because as I mentioned earlier, Monday morning was a bit bearish, but sentiment became more bullish towards the end of the day, and people have been attributing that to strength in US physical market, as well as recent for all the talk about being bearish on China, the recent Chinese New Year, the holiday, there was a massive travel boom, of course, anecdotally. It's always that time of the year, during the holidays, when there's a public holiday, bank holiday, all of my Chinese friends are all out somewhere traveling domestically. There's always going somewhere interesting. So that's the time everyone travels, because people don't get much time off during the other times of the year. So when there is a holiday, this is pretty much like for like working people, it's pretty much the only time people can get time off to actually go elsewhere, go away from their own cities. So in that sense, of course, it will look like there's a lot of demand during that time. And then at the same time, we're also seeing strength in the Dubai crude market. In the physical, there's been some local refiners snapping up more cargo since the mid-February holiday, as well as increasing term supplies from Saudi Arabia to March. So there's some optimistic signals in terms of consumption. I don't know how long this can sustain itself for, but it adds to this this bullish narrative.
Okay, yeah, that's interesting.
And
what else?
Another one, actually, so also from Bloomberg, it's a looming Venezuelan sanctions give a bump to Colombian oil prices. But although this is more focused on the South American market, it still comes down to what we had been talking about in the last 3 months about the impact of lifting Venezuela sanctions, but it has been very much very, very short-lived, because it seems like these are going to be resumed once again in April, and this will therefore induce a bit more heavy sour demand for maybe in North America or in the Middle East, which could be another bullish factor for Dubai crude too.
Yeah, I mean, when the sanctions got released, first thing happened, it seemed, was the residual fuel oil market weakened considerably. So that's like the very close to shipping fuel and kind of tarmac and bitumen. That really sold off quite aggressively, and I guess gone better bid now, and this is the opposite, right? A tightening of that kind of complex. So it's good news for Saudi Arabia, for OPEC, because the market share that's been going to the US, that's been going to Russia increasingly, this is a chance to get a bit back. So if anything, I can see this being perfect timing for OPEC, because April is around the meeting, right? So whatever there's sanctioned against Venezuela can be kind of brought back online from other OPEC members. It might be marginal, but it's still, every little helps. So that is definitely worth saying. But I've got to say, like, those interesting articles, it's been an interesting couple weeks, but I don't know, seems to be toning down quite a bit, and you do tend to get like a bit of a, from the market, it's people trading ultimately, at least in the OTC market. Of course, there's a lot of algorithmic moves as well, but it seems like the pulse of the market is kind of slowing down, and there's not a huge amount of things to get upset about. I mean, we didn't even mention Red Sea there, and that's obviously been going on for a hell of a long time. So I would say I'm more on the side of bearish volatility going forward. At the same time, a collapse would be a highly volatile event, but it just doesn't seem the market is long-term set up for a collapse or much for a rise either way. So we've just got to keep an eye on it. But I just thought that was worth noting, because it's, not saying you're boring, but it wasn't that nothing that crazy going on. So who's doing the trade idea this week? Martha.
So this week we're looking at a fuel oil trade idea to sell the 3.5 barges crack, which is the high sulfur fuel oil crack for Europe. We're looking at financial and physical reasons for this trade. Firstly, we're seeing really, really high stock levels in the ARA, which you can see on screen now is the highest, essentially the highest in like 2 years, and that's kind of bringing about a bit more of a weak sentiment into the market. We've seen more cargoes into Europe from the west and the east, and financially we've seen the market kind of flip into April from March. So we've seen good trade house selling in both the 3.5 barges crack, which is the European high sulfur fuel oil crack, and the 380 crack, which is the high sulfur fuel oil crack for Asia, by trade houses in particular. So we'll put those graphs up now as well. So this is important, as we mentioned earlier, to kind of keep an eye on the liquidity and volatility here. As this is like a European trade, we may be seeing a lower liquidity due to the IP week, and also it would be, if we see any gapping down in crude, that would also be a good factor for this trade as well, as that's such a heavy product, it could be quite closely correlated.
Yeah, this is an interesting one, because so you're saying stocks are really high, and we are starting to see selling and an overly weighted long market as well, or?
I think outright we're seeing the market flip, like the momentum of like the 7-day market's trading split is beginning to, it's been quite evenly split actually recently.
Okay. But I think if it's about fundamentals, talking about the spread, so that's the physical differential into pricing, right? If you carry it into pricing. Mm-hmm. So the thing about April is the maintenance situation, right, in Europe. So the stocks might be high, But of course, that's a good thing for refiners as they go into maintenance. They're going to start drawing on those stocks. They can still basically honour supply agreements, not having to run. So you'd expect stocks to get drawn down. And just looking at the trader chat this morning, I was literally just flicking through it as you were talking there. The Russian government is going to impose a 6-month ban on gasoline exports starting from March the 1st and increasing standards for diesel fuel exchange sales to 16%. So in general, this seems like responsive to probably the Ukrainians bombing Russian refineries, and it's, you know, diesel and gasoline hugely important to the war effort and will continue to be so, as is always the case for wars for the last 100 years. So I think that's probably a response to that, and there's outages and there's maintenance coming. So I can see the logic in the trade technically, and I can see it probably could be quite a good trade. It's just that would be the number one thing to look out for. But at the same time, if all these things are happening, and you know the fuel market's gonna be more than aware that these things are happening, and it's still weakening, it's actually quite a bearish sign, isn't it? So it could have just overperformed, and kind of overly priced in these kind of things we're talking about. So it's quite an interesting one. So yeah, thank you for that. What about, just before we move on, Brent, do you want to give any views on that, Vincent? Because there's a forecast you guys put out this week that was actually more towards the bear side.
It was towards the bear side, and so that one had a target price of $77 per barrel. Okay. So it is, relatively speaking, more on the extreme side of things, reflecting a bearish view because of anticipated bearish macro sentiment. Momentum as of Monday morning was a bearish one. We expected, for example, we were seeing that Brent was trending down towards the low 80s, and from the CFTC data, it was initially showing that it wasn't because of longs taking profit, it was more short sellers coming in. Yeah. And so with longs still in the market, it meant that there's a lot of room for profit taking flows, and should prices fall below $80, then this would trigger potentially algo CDA selling flows, as well as more people taking profit, which meant that volatility could increase in the short term on the bear side. And if if inflation data was quite higher than expected, then this would be another bearish factor, which would add on to the existing bearish momentum. I
see what you're talking about. It's a shift. If it can't quite shift up, and we can almost guarantee the crude market being as bullish as it is right now, North Sea market being as tight as it is, there's going to be people positioning long in the outright price, and probably quite stubbornly so, saying, the market's strong, I'm going to be long here. So you've got that against the backdrop of increasing bearish momentum, purely technical, and then a rush of selling flow could come in once there's something on the Red Sea tensions easing. Israel-Palestine hasn't been talked about again last week or so. Those tensions ease, anything kind of risk off. I completely see your point. If that comes into the market and it's people who are long who are having to sell or forced to sell, or starting to see an easing of what we're seeing in the crude market, and so selling on that basis, either way you look at it, that could trigger a bit of momentum. So no, it's logical. But I think the spreads for the time being, it's all about the front time spread for Brent, which expires, as we said, on Thursday. That's getting towards $1 per barrel, which is very strong. WTI front spread went out very strong on its last expiry, and it converts to a cash spread, i.e. like the physical trading spread, and that was very, very strong. So that's the domestic US market is very strong, despite refineries being offline to some extent. So as they come roaring back, it's going to get just very interesting in general. But as is always the case, I mean, this has been such a common theme. Traders are looking at it going, look how tight the market is. I am not going to be short here. I can't possibly think of being short flat price. They're just being stubborn against the backdrop of all the things that drive markets these days in the outright price. And so it could just be a repeat. The stubborn people tend to be the ones that hold on the most and then have the most aggressive stop outs. So Okay, our poll last week was, which AI stock would you like to buy right now? So that was clear winner, Nvidia, 48% against Microsoft, Google, and Super Microcomputer. Not heard of that one, James.
That had an aggressive move. It went in the first about 3 weeks of January. It went about 300%. Yeah, and then suddenly sold off 30% in one day, just middle of last week.
Interesting. Okay. Well, I think we can summarize it as, if you do have access to Brent expiry, watch that. If you don't have access to it, we're trying to solve that. Maybe on Twitter or X. You'll be on X publishing, talking about it, commentating on it. No.
Of course.
That's the plan. So yeah, tune in to Vincent's Twitter or Onyx's Twitter. And then the Red Sea, the announcements, the macro situation. I think Vincent makes a good point. Ultimately, any easing of tensions, it seems to be skewed that way. So it's a kind of risk to the downside. So it's about talking about how you're trading your risk right now. If you're going to be long, it's got to be with structure, right? It's got to be with time spreads, with flies, with some key differentials. Outright price just doesn't look like the one that will perform reliably. And if you're looking at it from a sharp point of view, it's been a poor return on investment being long the outright versus being out long the time spreads, etc. So that's that. So we'll leave it there. Thanks everyone for coming in person. Nice to see everyone in the studio like this for the first time. And it's not the first time. That's not true. Anyway. We've got more interesting podcasts on the way, of course, new market ones, but more leadership ones. So please, as ever, like, subscribe, please follow. We're getting very, very close to that 1,000 subscriber mark. So who wants to be number 1,000? And I think there's a cake in the background waiting for that to happen. So if you want to support us, click that like and subscribe. If you don't want to support us, I guess you would do the opposite. But thanks, everyone, and see you soon.